Good evening. Markets open this week with fresh momentum and just enough uncertainty to keep traders awake. Dow Jones futures climbed sharply overnight, mirroring a rebound across U.S. equities as investors digested softer inflation data and renewed confidence that the Federal Reserve may be nearing the end of its tightening cycle. But beneath the optimism, the story is more complex, a mix of strong corporate earnings, fragile consumer sentiment, and a still uneven economy trying to find its balance. On Friday, stocks closed higher across the board. The Dow added over 400 points, powered by industrials and financials, while the S&P 500 and Nasdaq extended gains for a third consecutive session. Futures built on that momentum Sunday evening, reflecting both a technical rebound and what traders called policy relief. The latest consumer price index came in slightly cooler than expected, not dramatic, but enough to stir hopes that inflation may finally be bending toward the Fed's 2% target. That single data point changed the tone of the market. Bond yields, which had climbed aggressively for much of October, slipped back as investors rotated into equities. The 10-year Treasury yield retreated from multi-month highs, giving growth sectors breathing space. Tech names rallied, airlines bounced, and cyclical industries that rely on lower borrowing costs found new life. Futures tied to the Dow responded immediately, rising nearly 1% before the Asia session began. But here's where the story turns. While Wall Street cheered, Main Street hardly noticed. Inflation's moderation in the report was driven largely by energy and durable goods. Housing costs, healthcare, and services, the things people pay every month, remain stubbornly high. That explains the strange tension. Investors price in relief, but households still feel the pressure. And the Fed, aware of this divide, is unlikely to declare victory after one encouraging report. From a business and finance perspective, three layers define this rally. First, expectations. The market trades on what it thinks the Fed will do, not what it has done. Futures now imply a 50% probability of a rate cut by March next year. For a market addicted to liquidity, that is a powerful narrative. Yet the Fed has shown no official sign of easing, just patience. If economic data stays mixed, optimism may turn premature. Second, earnings and corporate resilience. More than half of S&P 500 companies have reported third-quarter results. Roughly 80% beat profit estimates, and those beats came not just from tech giants but also from banks, manufacturers, and retailers. Cost management, automation, and global diversification helped offset higher rates. For Dow components, these numbers underpin much of the current optimism. When industrial leaders like 3M, Caterpillar, and Boeing hold firm, sentiment spreads across the index. Third, positioning and liquidity. Futures contracts often move faster than fundamentals. Hedge funds covering short positions, institutions rebalancing portfolios, and algorithmic momentum all play roles in sudden overnight gains. This week's futures spike fits that pattern, enthusiasm reinforced by positioning. The danger, as always, is that when optimism runs ahead of data, corrections can be sharp. Beyond the numbers, policy rhetoric continues to shape market psychology. Several Federal Reserve officials are scheduled to speak this week. Any suggestion that rate cuts are on the table will likely extend the rally. But a reminder that inflation risks persist could send futures back down. Traders know the pattern well: rally on hope, adjust on realism. Globally, sentiment also leans supportive. European indices advanced, led by German manufacturing and improved business confidence. In Asia, markets opened steady, with Japan and South Korea tracking U.S. futures higher. Oil prices eased slightly, offering another tailwind to risk assets. Yet energy remains a wild card. Geopolitical tensions and supply shocks can reverse that support at any moment. For investors watching from the sidelines, it's worth remembering that the Dow Jones is both a barometer and a mirror. It measures industrial strength but reflects emotional confidence. Each tick upward this week is not just about inflation data, it's about belief. Belief that the worst of policy tightening is behind us. Belief that corporate America can weather elevated costs. And belief that the market, for now, can defy fatigue. Still, financial history warns that markets rarely glide in a straight line. The Federal Reserve's next meeting will be critical. If officials emphasize higher for longer, the current optimism could fade fast. Futures markets may be signaling relief, but policymakers see a broader picture: wage growth, service inflation, and credit conditions still hotter than comfort allows. This divergence between Wall Street and the real economy carries investment implications. Consumer debt levels remain near record highs, and delinquency rates on credit cards have ticked upward. Mortgage refinancing has slowed. If inflation continues cooling but growth also softens, corporate profits could be squeezed despite lower rates. That's the balancing act defining Dow futures now: enthusiasm versus endurance. Another important factor is capital flow. Institutional investors who had pulled back during September's volatility are gradually re-entering positions. Mutual funds and pensions are rotating toward value and dividend names, classic Dow territory. That inflow strengthens the base beneath the rally. Meanwhile, retail participation, measured by trading app activity, has risen modestly, showing that smaller investors are cautiously returning, but not in a frenzy. From a strategy lens, analysts emphasize 3 focal points for the week. Federal Reserve commentary: watch for tone shifts around employment and inflation expectations. Corporate guidance: beyond earnings, outlooks will reveal whether companies expect cost relief or sustained margin pressure. Bond market stability: as yields fluctuate, equity valuations hinge on whether fixed income remains calm or reignites volatility. If the Dow maintains its current path, technical analysts identify the next resistance around 39,000 points, with support near 37,500. These are not predictions, but psychological markers that often dictate short-term momentum. For futures traders, the play is clear: ride the optimism but hedge exposure. The broader lesson, though, is caution wrapped in confidence. Markets move not just on economics, but on emotion. After months of anxiety about inflation and recession, even modest relief feels like victory. Whether it lasts depends on discipline, both from the Federal Reserve and from investors themselves. So as futures climb and commentators debate the soft landing, remember that real recovery depends on stability, not celebration. The data may justify hope, but sustained gains require more than a single CPI print. They need productivity, wage balance, and durable demand.